morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar's 715th video, baby. Yeah. 715 videos. These are geared at teaching you how to be a better analyst of the commodities, stocks, futures, markets. And if you can become better at analyzing markets, you should get a little better at trading them at some point. First, you got to get the analysis right. Then you apply it towards trading. As we know, futures trading is extremely risky and can cause substantial financial loss. Traders, you might watch videos or see commercials on television where they say to you 15 minutes of time is all you need to get our system right. Hogwash. There is no system on the planet that you're going to get good at 15 minutes a day. You have to put every waking moment of your day, and try not to sleep at all, into this. You got to do your homework every night. You have to watch the markets all day. You have to make this your life if you expect to get good at it. So you guys that are out there trying this on a fly-by-night basis, trying it part-time, forget about it. You part-timers are never going to get this right. This video is not to convince people that trading is easy. It is, however, to convince you that technical analysis is the roadmap to where the future price comes from in the commodities markets. Traders, I am here to say this. Crude oil is the wild card behind our S&P market and U.S. world indices. The world indices are looking very strong right now. However, if you'll note down here, I have a red and green OMNI on my board. The indices are bullish. If crude oil moves higher, it is the joker. It is the wild card behind trading over the next few weeks. If you'll note, there's been no new geopolitical developments over the weekend, no earthquakes, no tsunamis, nothing insane for the news media to scare us with. So they'll have nothing else this week on their agenda unless something big happens but the crude oil. Once the news focuses on the crude, everyone starts to cry about the price at the pump, and the stock market feels the pain. We need to hope here that the crude does not take off, that speculative positions do not take crude to a level that knocks us off our perch and slows down, if not stops, the world's economic recovery. Certainly in the U.S. and Europe, we are in big trouble if that crude starts heading above 110 per barrel. I have some nice charts to show you. This is a weekend webinar, traders, so there's many charts in this video. I am not going to waste much time. I am here to say this. World indices looking strong. If it was not for the crude oil wild card, they'd be blasting off right now. But with the crude threatening to knock us off our perch, we have to be very careful how we approach these markets. For now, however, the analysis points towards buying the dips in the ES/transportation average, NASDAQ, you know, the world indices, the U.S. indices, and looks good in the FTSE and the DAX, the Nikkei, and the Hang Seng as well. These markets look fantastic right now. Again, I will say this. Crude oil is the wild card. I don't care what the charts look like. If crude goes too high, we are going down. Again, for now, we're going to buy the dips. Eyes focused on crude. With no further ado, let's go look at some charts. Okay, traders, the first chart before your eyes this evening is the leader of U.S. indice markets, the Dow Jones Transportation Average. As we have seen in many of our past few videos, we had this apex with the 65% false breakout rule. Once we realized it broke out falsely, it was going to break out towards the upside. You can see that this technique was quite successful, and we have broken out towards the upside in a smart way. Traders, look, we got above this previous peak. We got above that previous peak. We are higher now. That market looks good. The leader. If the leader is doing better and moving higher, the followers should certainly follow and do their job, being the S&P, the NASDAQ, and the like. Let's take a look at a few charts here. Okay, traders, if this 65% false breakout technique didn't convince you in the transportation average, this is the Hang Seng. It's across the planet, right? It's over in Asia. This market did the same thing. It put it in this pennant and then had around the 65% area. And traders, if you don't know what that means, you break this into 4 equal quadrants. This is about the 65% area. This isn't a great drawing with those 4 lines. However, once you reach out 25, 50, when you get near the 65% mark, you expect a breakdown and then a rally back out through that, and higher we go. So you see the transportation average did this exactly. The technique worked perfectly, and we are right here, right now, at this spot on the Hang Seng Index, and I'll tell you what, that worked perfectly as well. So followers are following the leader, doing exactly the same thing, only a little bit afterwards, as leaders would do. They would go first, followers follow as they do. So the transportation average literally is all the way up here, and the followers are down here still. I say they follow the tranny higher. Let's look at another chart. Okay, traders, so we've seen the leader, the transportation average. Then we looked across the planet. We looked at the Hang Seng. Now we're looking at the S&P E-mini. What you'll recognize on this daily bar chart is we held the OMNI average, took off. We are now in a parallel channel. Traders, we did the exact same thing here with the 65% false breakout, and we've taken off so far. If you're following the transportation average, you need to be up here right now, Mr. S&P. So it should follow in suit and head up here. Of course, the wild card being crude oil, that can put an end to our party. But as we look at these charts right here, the crude doesn't seem to be affecting anything yet, so we will buy the dips expecting higher. This is a well-defined parallel channel, that yellow channel that we're in. And we've gotten above the resistance created by the pennant right here, this line. So market looking good and strong for now, as long as crude behaves. Gotta love the S&P. Let's look at another chart. Okay, traders, a completely different technique, but another world indice, the FTSE, the Financial Times Stock Exchange, the London stock market. I want you to take a look at these very easy to see V formations. We start one here, drops down, rallies up, and puts in a higher high than that previous peak. Then we have another quick down V formation, a higher high. Another V formation produces a higher high. Right here, a V formation produces a higher high. Here, a V formation, you get a higher high. Look at the size of the V formation we're coming out of now. Where are we? We're here, no higher high yet. The higher high puts us up here somewhere, and that's what I expect to happen. The V usually results in a higher high. That's what we expect in the FTSE. So as you can see, world indices looking good so far, but let's continue to look. Traders, the DAX, the leader out of Europe these days, the German DAX. Look at the size of the parallel channel as it's expanded over the last few weeks. Now it's a nice fat parallel channel, and as a market grows in strength and moves higher, of course, its parallel channel will do the same because the dips get greater and the rallies get greater, so the parallel channel simply widens out. What's nice about this is we're back above the OMNI average, and as you can see, once you dip below and get above, you get a nice fat rally. Well, we dipped below, we're now above, and we just got above this resistance line. We are right here, settlement on Friday. You gotta love the DAX. Again, the only wild card is Mr. Crude. As long as the crude stays at least level or drops a little, this market explodes. Crude is the wild card. The DAX cannot handle crude going higher. The FTSE cannot handle crude going higher. The S&P cannot handle it. The world indices will crumble if crude continues to go higher. But for now, that DAX looks pretty good. Let's look at another chart. Okay, traders, Japanese Nikkei. This chart looks great. If you ask me, it's a daily bar. Look at how well flags work on this Nikkei daily bar, by the way. Bear flag produces big drop. Bull flag produces nice rally. Another bull flag looks like it's building right here. Likely will go higher again. Even if you just get up to the OMNI average, you got a long way to go before you hit that spot. So Nikkei looking bullish. As you've seen, I have not been able to find an indice chart that looks bearish yet. Let's continue to look. Okay, traders, now shifting gears, looking at a currency, the Euro currency June daily bar. Bull flag breakout. But look what happens after a bull flag on the Euro currency. You get a little consolidation period, then the blowout. So we just had a bull flag and a run up, maybe a little consolidation period, and the next blowout should come. That is what happens when Euro currency produces these bull flags. If you take this and extend this channel a little higher, it is perfect. It got touched on Friday morning and the market exploded. You gotta love the Euro currency. Now, there's a reason why all of this is happening, why the stock markets of the world are rallying, why the euro currency is rallying, even why the crude is rallying, and I'll show you that now. Okay, traders, here's the booby prize of all the charts, the dollar index. This is a weekly bar chart. Why is the crude going higher? Why is our stock market going higher? Why are world indices moving higher? Why is euro currency, Swiss franc, and almost every other currency on the planet right now moving higher? Because the dollar index is moving lower, giving us the opportunity to have our stocks look cheap, to have our bonds look cheap. Traders are coming into the United States as this dollar gets cheaper, looking at our real estate, looking at our investments, and beginning to realize the United States is in a recovery and its prices are cheap if you have currency that is not US dollars. So the game that the Fed is playing is keep driving the dollar down till the stock market reaches a point where everyone in the world wants to be in it, and then they can raise interest rates and take the dollar higher again. For now, their plan is working. Shoulder, head, shoulder, dollar index. This is a huge head and shoulders on a weekly, absolutely pointing towards the downside. Is there confirmation? Yes. Inside of the head is another pretty large head and shoulders. Inside of the right shoulder is a pretty large head and shoulders. Traders, this is an indication that this market still must continue lower. And until the Fed starts talking about raising interest rates, this will continue to move lower, giving buoyancy to the crude, giving buoyancy to the U.S. markets, stock market that is, and to some commodity markets. The cheaper the dollar gets, the more expensive world commodities get. So the dollar is giving us the opportunity to have a strong stock market and strong crude at the same time. The problem is, if crude continues to move higher, we are going to run into trouble, and let me show you why. Okay, traders, the chart you're looking at now might seem a little complicated, but it is quite simple. This is a weekly chart of the E-mini S&P, and in green, it is a weekly chart of the crude oil. So, going back to 2005, 2004, 2003, leading all the way up to 2007, you had a nice movement in the crude moving higher, nice movement in the ES moving higher, big booming market for a few years. What happens? Crude oil hits 110 for the first time ever right on this date. You want to see something amazing? S&P puts its all-time high in at 1577, 1 week prior. Right there, as crude reaches $100 a barrel, S&P tops out. By the time crude hits 110 on this week right here, S&P is already all the way down here. Once crude breaks 110 and moves higher, when it hits 120, S&P is here. When crude hits 147, S&P dumps all the way to 666. You cannot have crude oil getting up here without the S&P starting to run down here. Now, granted, traders, we did have a little bit more going on in the world when crude hit 100 last time and 110. You had a failing derivatives market and a crushing real estate market along with crude rallying. So that tells me that you can likely get 115, 120 out of crude before it really tops off the stock market. Let's hope we do not get there, because there is no way we can sustain prices up here. You see what happened. Traders, this was the high in crude. By the time we got there, we were putting in the lows in the S&P, right? This was the high in the S&P. It only took 100 to 110 in crude to wreck our market after putting in all-time highs for the first time ever. That's big. I am telling you now that speculators are going to take this higher, and if they do, the world is in trouble. Traders, there has been no disruption in crude oil at all whatsoever. The supply is there. The demand is actually waning slightly, and still the price is going higher. Can anyone explain that? Speculators are certainly part of the reason why it's going higher. Yes, the dollar moving lower is not going to keep crude down, but it will just level off and slowly move higher if specs weren't goosing it. With the specs goosing it, if they get us past this level, we are in trouble. Let's look at one more chart. Okay, traders, another crude oil chart that I had showed you a good week or so, maybe 10 days ago in a video, and I explained to you that small head and shoulders in a much larger bull market are merely continuation patterns. Do you remember when I showed this chart last? Absolutely. Okay, so here we are, shoulder, head, shoulder. I have not modified this chart at all. It is the exact same chart that was in the last video. Shoulder, head, shoulder. continuation pattern because it's a small head and shoulders, not that monster one I showed you on the dollar index. Very small, means continuation. Goes to another shoulder, head, shoulder, continuation. Goes to another shoulder, head, shoulder that we're coming out of now, continuation pattern. Traders, I had this set there and this line exactly where it is now last time I showed you the chart. However, look at the bars that filled in all the way up to here. We're here right now. So, looks to me like crude wants to go higher, and if it does go higher, we're going to have some trouble in our stock markets. Remember, we're only at 108 in crude right now. We probably can get to 115, 120 before the panic hits, but if we get up there, all bets are off for the stock market to move higher until crude levels off again. Keep your eyes peeled on crude. Pull your own charts, look at world indices, look for the techniques you've just seen in this video, and I will meet you all back at the site. So, traders, you've seen the charts. There is my technical argument for why the crude oil is the wild card. It is the joker in the deck. It is about the only thing that will stall our world indices from moving higher. Right now, they are poised to move higher. Technically, they look fantastic. But if crude oil moves too high, the fear will be set in everybody out there, and we will pull back in the stock market. We do not need that. Traders, as I said during the chart segment, there is no disruption in crude. There is no difference in the amount of crude out there right now. The supply is there, right? The demand is the same. There's no new pent-up demand over the last few days. Why on earth is the crude going higher? We need to stop the speculators from ruining our economic recovery. If you'd like to get behind me on this, write some letters, put some comments on my video, get in touch with us, call your senators, write some letters to congressmen. Listen, traders, I think that you need speculators in every single commodity market out there that I've ever studied, with the exception of crude oil, because crude oil does not need the added liquidity speculators bring. Crude oil has every country on the planet lined up every day to buy the crude, so there is plenty of demand to meet the supply at all times. You do not need bettors in there goosing that crude oil market because of the effects and how quickly we feel those negative effects across the globe. Every country feels it. Every company on this planet feels it when crude goes higher. If companies have to start laying off because the raw material costs more to ship to their factory, then the product costs more to build because the factory uses, of course, energy to run its machinery. So to build your product costs more. To get your product out to market costs more because of transportation. Then when the consumer drives to your store to pick up that product, he can't afford as much because of the high price of gas he pays every week. That hurts every company on the planet, every country, every company, every one of us. Traders, we do not need to see this wild card get used. I hope no one gets a chance to play that joker, and the only ones who can play the joker right now that have any care are the speculators. If you think for a moment that the cartel, the oil cartel over in Middle East is going to try to tighten the spigots or pull back on spigots, you need to realize something. The oil-rich ministers across the Middle East during 2007, 8, and into 9 watched their own fortunes dwindle almost down to nothing because what happened is the price of crude went so high, the investments of the world were almost worthless. They seen their own investments, all the money that was made on high-priced crude go right out the window because they almost went broke when we almost went broke, when Europe almost went broke. Most of that was due to the high price of crude. They watched the shining star in the Middle East, Dubai. They watched Dubai go bankrupt. You don't think at this point in time they realize even if they make $1 billion or $100 billion or $1 trillion this year, it's not going to matter if they wreck the world's economies. That money isn't going to help. So you better believe the oil cartel, OPEC's got those spigots as wide open as they can make them, and they're going to keep them that way because they don't want to lose their money like you don't want to lose yours, like I don't want to lose mine. So I don't think we have OPEC working against us right now. I think they are on board to keep the spigots open so that we can have our economic recoveries around the world. What is left? Speculators, traders, that's what this is about right now. The specs are going to take this higher, and you are going to feel it. I don't care what people think about free market, free society. You might have that argument. It's a great argument in every other commodity but crude. Once you look at crude, that argument doesn't fit because of the supply-demand, equally big as on either side. And it is the one market on the planet that destroys world economies like that. Traders, specs need to get out of this. That's the last word in this video about that. All right. Listen, if you like the techniques, the technical analysis I showed you in the chart segment a few moments ago, and you'd like to study with me here live in Vegas, fill out an OmniCamp application. We are having an OmniCamp the last weekend, most likely in May. If you'd like to show up, fill out an application. I will call you and qualify you personally. Only 5 of you will be allowed to come this time. So please make sure you fill out those apps at our site. It's livewithoscar.com and click the OmniCamp application. All right, traders, for you traders who did fill out the applications in the last few weeks, I start calling this week. Expect a phone call from me. Make sure you show up at the site. Make sure you don't trade alone. Come in my trading rooms where I can help you understand the techniques I just showed you on the board. Traders, crude's the wild card. If you buy anything at all or sell anything at this point, a stop is absolutely your best friend. Never put on a commodities and or any other position without putting your stops in first. And don't forget, keep your emotions out of trading. One of the best things you can do to help yourselves with the emotions at bay. And traders, let me tell you something. If you make emotional decisions, your money goes out the window like that. You got to have a trading plan. You got to plan the trade before the markets come your way. And you have to execute that plan. Plan the trade, trade the plan. If you do that and you place your stops first, you can keep your emotions at bay. One of the other things you should do is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Yeah. Thank you, thank you, thank you.
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.